And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning, it's Tuesday, and it is the second day of the week. I'm your host, Lance Roberts, for The Real Investment Show. Yes, I'm sorry we were off yesterday. Just want to give you the exact definition for job security. Brent had to be out yesterday to take care of his lovely wife. I can't do a show without him, so, you know, that's what you call job security right there. So he's going to be like a weekend at Bernie's. If he ever dies, I'm just going to have to prop him up in the studio so that we can do a show for you in the morning. So anyway, here it is, second day of the week. Markets yesterday opened up fairly strongly and looked like out of the gate we're going to have some good follow through from Friday's nice rally. You know, remember on Friday, markets were up a little over 2% because of the whole, weaker wage growth that was in the jobs report. Jobs report was strong, but wage growth was a little bit weaker, right? So it wasn't growing as fast. And of course, that got all the pivot bulls very excited. On Friday, markets had a nice jump right up into this cluster of resistance. We've been talking about this for the last few days. A lot of resistance right here where markets are trading. The 50-day, the 20-day, 100-day, all intersecting with each other. Market ran right into the 50-day yesterday. Fell off of that. After we had that nice open, the rally market sold off all day yesterday. Actually finished the day very slightly negative, but negative nonetheless. This morning, futures pointing down a little bit more because we have Jerome Powell speaking this afternoon. Now, the big question, of course, is that will Jerome Powell play smackdown on the markets again, because that's what he has been famous for doing here as of late. Of course, you remember back in early December, markets were kind of rallying fairly nicely, holding up here right around the 200-day moving average. Actually had broken above the 200-day. Everybody got all excited there real quick. And then Jerome Powell came out and said, hey, stop that, because every time you rally the market, that eases financial conditions, and their FOMC minutes, which is what led to this big sell-off in the market, said market rallies are easing financial conditions. That's not what we want. Stop that. And of course, that's what led to the sell-off in mid-December and led to this kind of basing period that we saw at the end of the month. Now, again, markets did rally here on the first 5 days of January. So goes the first 5 days of January. So goes the month. Theoretically, that's what the old saying goes. Of course, we're all going to be watching the Super Bowl indicator next. Because those all pertain to what happens for the rest of the year. And of course, everybody's hoping right now that we're ultimately going to have a much better cycle for markets this year than we had last year. Of course, last year markets were down about 20%, nominal basis, total return basis down 18.1% last year. So again, markets were down decently last year, but everybody's all kind of been out of shape about the first down year we've had in basically about 11 years of any consequence. Markets had a very, very strong run from 2009 to all the way through 2021. So having a down year, everybody's all in a contank about this whole down year in the markets. Like, oh my gosh, the world's coming in. You had 12 years of a market advance, people. So having a down year, not surprising every now and then. And again, we go back and we take a look at, really what's happening with markets. Not a lot. I mean, you take a look at a very long-term trend of the markets, and it's been ever since really 2008 when we get back to the financial crisis, which was now just this little bitty blip over here. Here was your financial crisis. I mean, barely even shows up on a chart now because of this massive run in the markets that we've had since then. And importantly, this bullish trend of the market has not been broken. So yeah, last year really kind of sucked, and there's no way around it. Markets were down, stocks were down, bonds were down, everything was down last year. But again, nothing outside the realm of just a normal correction within a market that had a very sharp linear advance because of all that fiscal stimulus that we put in the markets. $5 trillion worth of liquidity. Think about that for a moment. And this whole advance here, I want you to contemplate this for just a second. This whole advance here was driven by $44 trillion worth of fiscal liquidity and monetary liquidity put into the markets and the economy by both the governments and the Federal Reserve. That's HAMP, HARP, TARP, QE, QT, you name it. All the different programs that we've been injecting into the financial markets for the last 12 years. $44 trillion. That's almost as much as the entire world economy all put together was all injected into the U.S. economy. Not surprisingly here that you're going to get this run in assets. And then when you throw $5 trillion worth of money into fiscal stimulus into household bank accounts, not surprising that you get this massive surge off to the moon. So a correction of that process as that money comes out of the system should not be surprising, but it's not the end of the world, right? It's, the world's not going to end, the dollar's not going to go away. It just, all these kind of end of the world doom and gloom predictions, not going to happen. It's just simply a function of a reversal of liquidity. Could markets go lower? Yes. To come down and retest kind of this upper trend line would certainly not be surprising at all this year. Again, particularly as the Fed continues to hike rates, as they continue to put pressure on the economy, that's why they're hiking rates. If you take a look at what happened with credit card debt, yesterday we had the credit card debt numbers come out, huge surge in credit card debt. Not surprising. Individuals, that all that money they had in their bank accounts from those checks, those $1,400 checks, it's gone. Inflation's up, things cost more. Well, my job's only paying me so much, so in order to buy stuff that I need like food and gas and those type of things and paying bills, I don't have enough cash for it. I've got to put it on credit cards. A lot of people right now, and this is what coming out of the credit card surveys, are spending a lot of credit card debt on basically living needs. Now they're not going out and using their credit to go buy a new television or take a trip. They're buying groceries on credit, and of course they're paying a huge amount of interest for buying groceries on their credit card. So that's eating into this. We've had this huge surge. We've had a record surge in the amount of credit card debt, and credit card interest rates are at the highest level we've seen in decades. So, this is really going to impact the consumers, and not surprisingly, that's going to slow demand. But this is what the Fed wants. This is why the Fed's hiking those short-term rates, which is what affects the variable rate on credit cards, etc. That's what the Fed wants. They want tighter financial conditions that weigh on consumer sentiment, right? Because they want people to spend less. That slows the economic demand. That creates, if there's less demand, that means prices have to fall. That's just the way the system works. So again, what the Fed is trying to do is extract that fiscal python, or that fiscal pig, out of the economic python, and that's what they're working on right now. And again, this is why we've gone through this period of time. That's not the end of the world. It's just the reversal of the process that drove us to this point to begin with. So, 2020, 2021, we had this huge surge in the markets. That's all fine and dandy. Great, no problem. But the consequences of that ultimately is that you've got to reverse that policy unless you're going to keep sticking money into the markets. And this was always the problem, and we'll talk about this after the break, with modern monetary theory, because this all kind of ties into our blog post that's out on the website today, which is talking about the actual fiscal pig and the economic python. It's on the website talking about specifically this. But right now, just pay attention to what Jerome Powell wants, and this is something he'll probably reiterate today and probably will weigh on markets as well, is that the Fed is going to remain hawkish for now until they start to see a clear trajectory in inflation down to lower levels, and that means that no pivot is coming, and that'll probably disappoint the bulls. Be right back after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you as worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. I'm Real Lance Roberts, Brent Clanton joining me as well, of course, and a few things to get into this morning. We have a new article out on our website this morning, and it's talking about this whole idea of this fiscal pig and the economic python. And the point of the article is discussing this $5 trillion worth of liquidity that was injected into the markets. And again, while there's a lot of hope here that markets can continue to rally, one thing you've got to think about is just the reversal of what got us here, right? And this is the one thing I just kind of continue to think about a lot. And again, as we talk about here, is there a possibility that the economy can avoid a recession this year and earnings maybe come in better than expected, right? They're not as weak as expected. I mean, sure, those are all possibilities. And I think you have to give some credence to that. There's, there's a lot of very bearish comment out there that's simply, the market's going to go down and we're going to have another negative year. And that's certainly, I can make a very strong case for that, right? The Fed's hiking rates. Fed hikes rates, they always cause a recession, et cetera, so forth and so on. But I think we have to also think about the other side of that coin as well. When everybody assumes something, right, you have to make room that everybody is potentially wrong, right? Because that's the way markets work. What markets are looking for are these kind of displaced opportunities. So if everybody is short the market, right, then that provides a lot of fuel for a counter trend rally of magnitude. And that's why markets tend to do the opposite of what everybody thinks. And there's a lot, this is why contrarian investing works over time, is because when everybody's on one side of the boat, typically whatever's happening, or what will come is on the other side. And this, a good example of this was everybody hated energy in 2021. And nobody wanted to own energy stocks. It's not clean energy, and oil prices were low, and blah blah blah. Right? Nobody wanted them, and we were talking about energy stocks would be a good place to be because everybody hates them, and they turned out to be a good place to be. And the question, of course, now is as we move into the new year, where do you want to be? And right now, everybody wants to be out of the market. I don't want to be invested. I don't want to own stocks. I want to own, gold and other stuff, and that's fine. Nothing wrong with that. I'm not saying that that's not the right place to be. I'm just throwing out this idea that if everybody thinks that, what is the counter trend trade? What is the contrarian place to be? And so there's certainly a lot of comments out there right now about how bad things are going to be, but there is a possibility that they're wrong. So what would that be, right? That would be an economy avoiding recession. That would be earnings not coming in as bad as expected. And that's an argument that is very tough to make data-wise. And part of the discussion that we're having today in the blog post is talking about this $5 trillion worth of liquidity that we shoved into the system that's now working its way out of it. And there's no more coming. And it was interesting because if you didn't pay attention to this whole McCarthy issue that was going on, and so they were trying to elect the Speaker of the House, and it went through 15 votes in order to finally get Kevin McCarthy elected Speaker of the House. And without that, it's like, well, what's important? Well, without that, you can't do anything. Without a speaker, you can't pass any legislation. You can't have any appointments to committees, nothing, right? That all goes through the speaker. So you have to have a speaker. I mean, everything's dead until you elect a speaker. And so for 15 rounds, we go through this whole drama. And, you're sitting back going, what is going on here, right? What is happening? Well, turns out that there were a group of Republicans that were actually working in your interest, and they did a very good job. And what they did is in order for Kevin McCarthy to get their vote, they had to reverse all the rules of how the House works back to before pre-Obama. After Obama got elected and Nancy Pelosi, they changed all the rules to make things much easier to pass these kind of omnibus spending bills, right? These $1.7 trillion monstrosities that create these funding issues. And that also is part of this process, because now what these rules state is that, every bill has to be a singular bill, right? If you want to pass money for funding, a particular economic project, that's it, right? You got to have a bill for that. You can't have that bill and then 4,000 other pieces of funding shoved into that bill at the same time, right? So it's just getting Congress back to working the way it's supposed to work from a fiscal standpoint. So it just really returns a lot of the congressional rules back to the way they were supposed to be and the way they were intended with the Founding Fathers. So it's actually a very good thing that occurred. Here's the bad thing. You're not going to get any more of those $1.7 trillion spending bills. One of the things that they passed, and one of the things we've talked about here on the show quite a few times, we haven't had a budget since 2008. 2008 was the last budget we had, and this is part of that rule change, right, where we started just doing these continuing resolutions. Every time we got to a debt ceiling, we just passed a continuing resolution that automatically increased spending for the government by 8% and blah, blah, blah. Kept running up our debt, right? $31 trillion. Can't do that anymore. Part of the agreement for Kevin McCarthy was to go back to a budget process. Amazing. What that means, though, is you're not going to get checks to households. You're not going to get another $1.7 trillion worth of funding, right? It's just, that's not going to happen. So all this kind of runaway spending is going to be put under tap here for a bit, which means that all that liquidity that was injected into the economy is now going to come out at a time where the Fed is hiking interest rates and doing quantitative tightening. This is going to be more problematic in terms of generating earnings growth, considering that earnings growth have to come from economic growth. And so all of this lack of liquidity, this lack of capital in the markets, this retraction, combined with higher interest rates, that's going to slow economic activity. And it's going to slow demand. And as you have slower demand, That's where earnings come from. So there's going to be a risk here, and I think a viable risk, that earnings come in weaker than expected over the course of this year. And look, expectations are coming down. Earnings are coming down. They haven't come down enough yet. We've talked about this on the show quite a few times. But earnings have to fall because the economy's going to fall. Now, that doesn't mean we're going to be in a deep, dark recession and you need to be in, a bunker with beanie weenies and ammo. I'm not saying that, but, avoiding a recession is going to be a challenge. Can it be done? Sure. I'm not sure how it's done, but it's possible we could avoid a recession. Look, nominal growth is still, on the economy, still fairly high. So you've got to cut a bunch of economic growth because of the nominal increase that we had in economic growth in 2020 and 2021. You had this huge surge in economic growth because of all that stimulus, right? All that's got to come back out again. So you've got a long ways to fall on a nominal GDP basis just to get to a recession. And then, of course, the question will be at what point does, things start to kind of stabilize? We get back to some level of normal. This is going to be the real challenge this year. So I think you have to build in the case for both models. You've got to build in a case for, again, it's a very easy case to make that you're going to have a recession, right? And you're going, well, Lance, then why be in stocks, right? Because we're going to have a recession. Problem is everybody thinks that. And there is this contingent of the market that still is bent over backwards trying to hope for, the Fed's going to give up any moment now and start pivoting and putting capital back into the markets, and markets are going to run off, and I don't want to miss the bottom. People are piling into the most risky assets again, emerging markets, international markets. Those, emerging markets in particular, they've been doing well this year so far. Coming right out of the gate, emerging markets are doing well. That's a very risky bet. Because if we have a recession here, we've talked about this before, because emerging market economies are exporters, their whole economy is based on exporting goods and products and services to where? The U.S. and other industrialized international countries. So if their entire economy is based on exports, that means they are dependent on what? Demand. If demand in the U.S. falls, in other words, if we get a cold in the U.S., they get the flu. So you got to be careful chasing emerging markets and international heading into a recession. It's not where you want to be. If we avoid a recession and demand stays high, they're probably going to outperform. So there's your conundrum, right? There's your risk. So these are the things that you've got to work through. And again, this is, I think there is one very clear, and this is the point of the article today on the website, realinvestmentadvice.com, is this whole discussion of monetary flows. This drain of liquidity is extremely important. The ramifications of that draining of liquidity is equally important. And I think that's the one thing, the one thing you've got to pay attention to this year is where the money flows are going to and where they're not. That's on the website now, realinvestmentadvice.com. We'll be right back after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So my kids know that I do radio, but they don't listen to it or anything. This guy sees me in the airport. So now my kids think, it's like, oh my gosh, my dad's really
Famous.
He's famous, right? Yeah, it's awesome. He's famous.
The Real Investment Show podcast.
So we get in the car and we find a Red Robin. It's packed. We've been there maybe 5 minutes. He comes over to me. He's like, come on, I got you. Puts us in a private room at Red Robin.
You know you've made it when you're an A-lister at the
Red Robin. Exactly.
At realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon. Register now at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, a couple of things, and again, just talking a little bit about, liquidity flows and why this is so important. And again, the big challenge this year, managing money, is just going to be whether or not we have a recession. Now, it's interesting because I'm actually writing an article about this, because there have been theoretically 3 times that the Fed has engineered a soft landing, right? And so you have to understand, what is the definition of a soft landing? Depends on who you ask, right? But a soft landing is technically the Fed hikes rates and the economy does not fall into a recession. But question is that really a soft landing? Let me ask you a question. Driving in your car, and you're going down the freeway and another car whips out in front of you and you slam on the brakes and you don't hit the car in front of you, but you slide into the median on the freeway and just completely damage your car, right? Totally. Now, you didn't have an accident with the other car, right? But you totaled your car. So technically, that's a soft landing, right? Well, the same idea here is that with the Federal Reserve, the idea of a soft landing scenario is they hike rates and don't cause a recession. But if you bang up a lot of other stuff in the economy, is that really a soft landing? As an example, 1984, Fed hikes rates, we don't have a recession. They immediately have to start cutting rates. Why? Because we have the savings and loan crisis that was caused by the surge in interest rates breaking the savings and loans. Okay. That's just one example. How about 1994? 1994, the Fed was hiking rates, didn't cause a recession. You caused the bond market to crash, but you didn't have a recession. So technically a soft landing. 2018, the Fed's hiking rates, don't have a recession. You have a 20% market decline that was immediately followed by a massive repo bailout of hedge funds that then ultimately led to an economic shutdown a year later where you have this massive 35% drop in the markets and a recession, and you have to come in and bail everything out with QE and everything else. Technically, a soft landing. Financially, not so much. So the question is, you really have to come back and say, what is a soft landing? And a soft landing is nebulous, to say the least. But the question is can the Federal Reserve engineer the soft landing scenario? And sure, it's possible. Again, as I was saying in the last segment, you've got quite a bit of headroom with nominal GDP growth that you still got to reverse before you get into recessionary territory. So, you may or may not have a recession, but you could crash the car anyway in a whole variety of other manners. The question ultimately is how's that going to translate into the financial markets, and how do you navigate that from here? That's going to be the real question. And again, you've got to be somewhat cautious here, but there's a lot of opportunity that's beginning to build up in the markets. And I don't know where exactly that point is going to be that you want to buy some of these really beaten up stocks, but you've got to start looking at the things that everybody else hates right now. And look, everybody's piling into value stocks, and that's fine. Value stocks worked great last year, but they're so overvalued. You take a look at companies like McDonald's and Coke and Procter & Gamble. These stocks are trading at astronomical valuations relative to their ability to grow earnings. These are massive companies that don't have really strong earnings growth, and they're consumer driven, which means they are subject to a restriction in consumer spending. So far, consumers have been holding up, right? Because they're going into debt to do it. But there's a point to where those consumers are going to contract. But if you take a look at Procter & Gamble, we've talked about this company before. Here's a stock trading with a forward PE, assuming they can actually hit their numbers, of nearly 25 times earnings. All right, it's got a price to sales ratio of almost 5. Now, we've talked about the importance of 2 times price to sales or 10 times price to sales in the past. And we talked about Sun Micro, and the CEO of Sun Micro at the time back in 2000 said, why are you buying my stock at 10 times price to sales? This assumes that I don't pay anything to anybody and I return every single dollar back to shareholders. That's the only way you can justify 10 times price to sales. I don't pay taxes. I don't pay employees. I don't pay vendors. I don't pay anybody, right? It's highly illegal, but that's the only way I can justify 10 times price to sales. And you got Procter & Gamble trading at 5 times price to sales right now. That means they have to basically grow earnings at 300% a year to justify keeping their price at 5 times price to sales. But that's where money flows are going, right? Everybody's chasing those dividend yielding stocks and paying astronomical valuations for them. We've talked about, and this is a company that's growing sales, but it's not growing sales at 100% a year. right? Coca-Cola, trading at a 6.2 times price to sales. McDonald's, Mickey D's, trading at 6 times price to sales. I'm sorry, 8 times price to sales. I mean, this is tech stock territory all day long. And their sales are basically the same as they were 5 years ago. They haven't grown sales in 5 years, and you're paying 8 times sales that they haven't grown. They've had 0 sales growth, and you're paying 8 times sales for McDonald's. But this is where money flows are going right now, right? Everybody's hiding out here. But this is why you've got to be careful. Disney's gotten beaten up. But they're still trading at a 54 times price to earnings ratio on a trailing basis. It's expensive. So this is the question, right? Is where do you start looking to invest capital? Because ultimately fundamentals do matter. The question is when do they matter? And unfortunately, we don't know when we're going to get there. But at some point, I suspect that we will. But you got to be careful of some of these stocks that you own and some of the stocks that you're chasing. Nike is a good example. Nike's had a huge run here since October. Still trading at 4 times price to sales with a forward PE of 31 times earnings. I mean, that's expensive for a shoemaker that has basically barely grown earnings over the last several years. So, these are the things that you've got to come back and reevaluate. And look, I'm not saying that we're not going to own these companies because they're just expensive, because, we want to, we're going to buy stuff where money flow is going to. But I think ultimately you have to come back and look at valuations and say, what am I actually paying for these companies and what am I expected to get out of this? And if we get into a recession, what typically works in a recession is these deep value companies that nobody wants. But as we talked about before, a big problem with the markets today, and I don't have a solution for this, is the whole problem of passive investing. We talked about last year as an example, you had more money flow into passive ETFs than you had at any other point since 2008. Massive flows into passive indexed ETFs. And that's because people are just, forget picking stocks. I'm just going to buy the ETF and just trade the whole sector. And look, I get it. That's easy, right? That's easy. That's an easy way to manage a portfolio, and it's cheap, right? ETFs are cheap. Nothing wrong, and there's nothing wrong with that, right? But as we talked about before, when you have a lot of money going into ETFs, that money flows into the biggest constituents of those ETFs, the ones that make up the biggest holdings. So companies like Procter & Gamble, McDonald's, Coke, these companies which make up the biggest holdings of these ETFs, and they're in multiple ETFs, by the way. I mean, every value index has that in it. Every momentum index has those in it because they have momentum. Every, growth ETF now has value stocks in it because that's where everybody's wanting performance, right? So everybody buys the same stocks that are going up in their portfolio, no matter what the ETF says, you're going to find a smattering of these companies in every ETF. And so there's hundreds of ETFs that own Apple and Microsoft and Amazon, whatever, hundreds of them. And so every time somebody buys these ETFs, money flow is going into those stocks. And that's why you get these periods where, you have these stocks just trading at massive valuations. And that whole passive indexing problem is what is frustrating fundamental investors because stocks that you may want to own, like say a Verizon, as an example. Here's a company trading with a 6% dividend yield, has an 8 PE, price to sales of 1.2. Nobody wants it. AT&T is another one, right? Nobody wants it, but I hate AT&T. So company just makes me mad. Anyway, things to think about. Where is everybody going to now versus where they will probably want to be depending on the outlook for the markets and the economy later this year. recessions tend to revert valuations. Something to think about. All right, come back, wrap up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Are you as worried about estate taxes as we are? Our first Lunch and Learn of the new year will focus on family limited partnerships. This valuable tool in the tax code could provide your estate with the safety and security you crave for your family. Join Richard Rosso, Danny Ratliff, and special guest Chris Masters, CPA with Doran Mayhew, Thursday, January 12th at noon, with the ins and outs of family limited partnerships for your estate and tax planning. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. Getting ready to wrap things up. Futures pointing about 155 points lower on the Dow. S&P, NASDAQ also pointing a bit lower this morning in anticipation of the much vaunted speech for today from Jerome Powell. Will he, do another market smackdown? That's going to be the big question, right? Every time markets rally, he comes out and pretty much throws acid on it. So today may very well be another one of those. It's like, at some point you almost have to figure that the bulls are going to get the message. I guess this is the big battle, right? Who's going to win this debate? It's like me telling my kids, like, no, you can't do that. But Dad, no, you can't do that. But Dad, no, but you can't do that. Then they go ask their mother, who says yes. So, this is the battle right now between the bulls and the Fed. And the Fed keeps saying, no, I'm going to keep hiking rates until you get the message to stop running up asset prices. But they haven't got that message yet, so we'll see. Improving fiscal health, saving more money, exercising more, eating healthier, being happy, losing weight, paying down debts, improving mental health, learning something new. Brent, what are those? What do you think?
Why, those are resolutions for 2023.
Those are resolutions for 2023. Yeah. Those are the top resolutions for 2023. How many have you broken this year already?
I didn't make it. I knew better. I resolved long ago not to make resolutions.
That's typically...
It's the only one I've kept.
My resolution, I have never broken, not making resolutions. It's actually not a bad idea. It is interesting that if you break it down by category, 65 and older, 18 to 29, the ones that are the closest together, in other words, the ones that 65 and older make versus 18 and 29, the ones that they most make that are closest together, improving physical health, saving more money, exercising more, and eating healthier. Those are pretty much all clustered together. So, and not surprising. Problem is that right out of the gate, we don't spend more money. We don't, it's like, so, my wife and I joined Orange Theory. Let me put it this way. I work out every day at the gym. Brent will tell you that after the show, I go down to our gym. We have a gym in our building, so I go downstairs and I work out every day for an hour or so. And then I go do whatever else I got to do for the work. And so my wife she finds this thing called Orange Theory Fitness that she wants to go to. And of course, she's like, honey, will you go do it with me? So now I'm working out twice a day.
Why wouldn't she use the facility in the building since she works here?
Because she needs something that's entertaining. Right.
Yeah.
And so Orange Theory Fitness is a very rapid moving. It's actually a great workout, right?
Yeah.
Because you've got a coach there that's telling you what to do, and it's constantly changing. So for somebody with ADD like my wife, she needs that constant, change of things, right? So just, doing, lifting weights is boring, right? So she can't. And look, I get it, right? Lifting weights is boring. That's why most people don't do it.
Well, Rosso did Orange Theory.
Yeah, no, he still does.
He's lost a ton.
Yeah, it looks great. But no, it's a really good workout. But since she's doing it, guess what? I have to do it with her. So I'm now working out in the morning at the gym, and then I'm going to Orange Theory at night with her. So you're
exhausted.
I'm exhausted. She wears me out. But the point is at least so far, I've kept my resolution of exercising more and eating better. I'm keeping those resolutions.
Yeah.
Those were easy because I was doing those before.
You sort of already hedged your bet.
Yeah. So my resolution this year is to figure out how to do more video and less writing. That's going to be my New Year's resolution.
Well,
I haven't figured that out yet, but
there've been some developments on that front.
Well, I know that, but the problem is every time we start doing more video, we get smacked down by Google for something. So
you people.
Yeah.
That's all I'm going to say.
You people being Google. That's
yes.
what, yeah.
Yes.
Google or Facebook, they're a nightmare. Anyway.
It's a meta mess.
Yeah, exactly. Anyway, a couple of things. And we talked a little bit about this morning on Twitter. So if you go and follow me on Twitter, at Lance Roberts is my Twitter handle. Every morning I post out and Twitter's fun because I'm like the worst guy ever on Twitter because I walk in the room and I drop this little bomb and then I walk back out. And then it's just fun to watch the feeding frenzy.
Yes.
So like I walked in the room this morning and I walked into the Twitter room this morning and I dropped this bomb. So it's a chart of cryptocurrency, which has just been flatlined for a year and a half now, right? Has gone nowhere. And so my tweet says, "Is it dead yet?" Hashtag cryptocurrency. And there's just all these comments now, just everybody starts fighting over.
It's this digital ripple effect.
It is. And it's just fun to start the argument and then leave and just observe it. I never respond to these people, right? But it's just fun to watch. They get all mad. It's like,
people get a life.
I know. They get so wrapped up into this stuff. And I'm like,
you know what
I said, if you don't like that one, here's another one. Yeah. Just to keep it going, right?
Well, the one about the motorcycles was pretty good.
Yeah. Yeah, I posted this one yesterday. It shows the deaths of different things, right? Pedestrians, bicycles, cars.
Fatalities.
Fatalities. Yes, that's what I'm looking for. So it shows fatalities by mode of transportation. And so most all the statistics are trending lower, with the exception of motorcycles, which is trending higher. And so I simply put out, I said, I've always wanted a motorcycle, but my wife won't let me have one because she always uses facts. And that's another one. I put that out there, man. People just went nuts over that one. Just yeah, you have to break it down by age. It's all the young people dying on motorcycles, et cetera. It's like, whatever. I said, again, I just like dropping the bomb and then leaving the room.
That's
seeing what
entertainment.
Happens. I know. That's what Twitter's good for, just getting people riled up.
And I can't take it more than about 5 minutes.
I know.
In there. Please go away.
Yeah. Well, again, you just can't respond to them. You cannot engage. Because even if you're using facts, you just it just people just start yelling at you on Twitter and just whatever. Your facts are wrong. Okay. go argue with the CBO, right? So, anyway, it's a lot of fun. But anyway, I do post stuff there every morning on Twitter. So if you want to go get yourself riled up, go follow me on Twitter at Lance Roberts. It's always some fun. And just know that half the stuff I post there is half of it's financial about markets and money. The other half is me just trying to start an argument. So just take it with a grain of salt.
You were that guy at school, weren't you?
Yes, I was absolutely that guy at school. Teacher said something, I would answer and then point to the guy next to me.
Yeah. If we'd have gone to school together, we'd have never gotten out alive.
We would have never graduated.
No.
That's for sure. It would have been fun, though.
Yeah.
Okay. Just checking the market here to see if there's nothing really changed yet. Just getting close to open. Things are pointing lower here. Just kind of keep a watch. Again, everything's going to trade kind of wonkish this morning until Jerome Powell drops his speech this afternoon. And then we'll see what the market does from there. Again, everything's going to kind of hinge on his outlook for hiking rates. Is there any, what the market's going to be looking for? Is there any change to his tonality in terms of potentially slowing the pace of rate hikes? And let me just reiterate one thing for you real quick. A pivot is not stopping rate hikes. A pivot is not pausing rate hikes. That's going to happen, right? The Fed is going to stop. The Fed is going to slow the pace of rate hikes, and they are going to stop at some point. That is not a pivot. A pivot is cutting rates and going back to QE. The market keeps hoping for this idea that the Fed will slow the pace of rate hikes or stop rate hikes, and that's being a pivot. That's not a pivot. Monetary policy is tighter, excuse me, and will continue to get tighter as they continue rate hikes. Even if they slow the pace, they are still tightening monetary policy that will impact and slow economic activity. So just keep that in mind. Outside of that, NFIB reports this morning as well. And of course, that is the measure of small business sentiment, and really that drives about 50% of the economy. So it's very important. And that prior number was 91.9. That was when you're below basically about 95, you're already in recession territory. That number came in this morning at 89.8. So you are getting well into recessionary territory. CapEx spendings continue to decline. Hiring continues to decline. Wages are still a problem. Labor costs are some of the biggest problems. The one thing we haven't seen tick up yet, but I suspect it's coming, is poor sales. And every now and then I do an article on our website. I may have to, I'll review the numbers today and see if it's worth writing an update. But the NFIB is a very good recessionary indicator. We don't pay enough attention to it, but it's such a large chunk of the economy, it tells you a lot about what's going on. So the NFIB report, much weaker than expected this morning. Let me take a look at the data after the show, and if it's worth writing an update, I will. But I suspect we're going to start seeing more alarm bells coming from the NFIB about where the economy is headed this year. All right, that wraps up the show for the day. Be sure and stick around our Before the Bell segment. Oh, by the way, be sure and subscribe. We have a new YouTube channel called Before the Bell. A lot of people are emailing going, hey, where's your 3 minutes on markets and money? It's on our Before the Bell channel. It feeds over onto our website, as usual, at realinvestmentadvice.com. But make sure you subscribe to the Before the Bell channel so that you get notified every morning when we put out Before the Bell. So it's got its own channel now, and so make sure you're subscribed there as well. So you have the Real Investment Show and Before the Bell. Subscribe to both of those and make sure you're notified. All right, thank you very much. We'll see you back here tomorrow in the next edition of the Real Investment Show, Before the Bell. Be sure and subscribe. Coming up next.